Hi, my name is Brian Nguyen, and I'm here to introduce Nike versus Skechers, two giants in industry, that being the shoe and athleisure game. If I were to ask you which company was larger, you would most likely tell me Nike. Why? Well, most likely because in your everyday life, you've seen more people wearing Nike shoes and clothes compared to Skechers. It's probably due to its vast popularity in fashion to even streetwear. Even some celebrities and media wear Nike even though it's not a part of their brand deal. As seen here, Kanye West, one of the biggest celebrities on the planet, was even caught wearing Nike shoes when he was signed with Adidas. In case you were wondering, he was wearing Flyknit gray and black shoes. Now switching over from observations to ratios, here is Nike's and Skechers' current ratio. As you can see, at the end of the fiscal year, Nike had a 2.10 to 1 current ratio. Although this is lower compared to Skechers' 2.27 to 1, both possess an ideal ratio that companies want, being higher than 1 to 1. This means both companies will be able to pay off their short-term liabilities. As for inventory turnover, Nike has a 3.98 inventory turnover against Skechers' 2.82. In this instance, Nike is closest to the ideal inventory turnover, while Skechers is 1.18 away. Having a good inventory turnover eases the burden of restocking your inventory, while still having a good balance with sales.
Now we will look at earnings per share, which is net income after tax that is available to its stockholders, then divided by the number of shares. Earnings per share is one of the key ratios that people who are looking to invest will look at, as it can show them how profitable a company can be for them. For 2019, Nike had 2.54 earnings per share. Skechers had 2.27 EPS for 2019. These are both considered to be good earnings per share. Now we will look at the debt to assets ratios for Nike and Skechers. The debt to assets ratio is a ratio that measures the amount of total assets that are funded by borrowing money. You can get the ratio by taking the total debt and dividing it by the total assets. An ideal debt to assets ratio is around 0.4, and once it gets to around 0.6 and above, it becomes possible that the company cannot pay all of their debts. For the fiscal year of 2019, Nike had a debt-to-assets ratio of 0.62. While this may seem high, Nike is such a large company that it still has the ability to pay off its debts. Skechers' ratio for the fiscal year of 2019 was 0.48. This is hovering right around the ideal debt-to-assets ratio.
Hi, I'm Hayden, and the next thing we will be looking at is profit margin. To find profit margin, I divided net income by net sales revenue. This percentage reflects how much money the company makes per dollar of sales. In 2019, Nike was more profitable than Skechers with an average profit margin around 10%, whereas Skechers has a bad profit margin closer to 6%. This means that Nike makes 10.3 cents per dollar of sales when Skechers only makes 6.64 cents per dollar of sales. With Nike's good profit margin, the company can choose either to reinvest in the company or disperse dividends to shareholders. Next is return on stockholders' equity. The return on stockholders' equity is found by dividing the net income by the total stockholders' equity to find a percentage that shows how much money is returned to the owners for how much they invest or retain in the company. In 2019, Nike's return on stockholders' equity was 44.57%, while Skechers was only 13.67%. This means that in 2019, Nike's return on stockholders' equity was 30.9% higher than Skechers, showing that they are the more profitable company. This means that for every dollar the Nike owners invest in the company, it has a return of 44.57%.
Hi, my name is Akshay Oberoi, and I'm going to provide a quick recap of Nike's ratios. In the 2019 fiscal year, Nike had 4 strong ratios compared to its competitor Skechers. Firstly, Nike's inventory turnover of 3.98 takes the edge over Skechers' inventory turnover of 2.82. How quickly a company moves its inventory is an important indicator of liquidity for investors. They will be more likely to invest in a company that has an efficient inventory turnover. From an investor's perspective, Nike's inventory turnover of 3.98 will be more favorable compared to Skechers' 2.82. Next, Nike's earnings per share of $2.54 was better than Skechers' $2.27. Investors are generally drawn to companies that have a higher earnings per share since it is a crucial component of a company's overall profitability. In this case, Nike's earnings per share outshines Skechers' earnings per share and gets the win from an investor's perspective. Furthermore, Nike's profit margin of 10.3% was higher than Skechers' profit margin of 6.64%. Profit margin provides insight as to whether a company's stock will provide a good return. Therefore, a higher profit margin is ideal, and Nike takes the win from an investor's perspective. Lastly, Nike's return on stockholders' equity was 42.47%. This was significantly higher than Skechers' 14.67%. Since this ratio gives insight to investors on how efficiently a company handles money from its shareholders, a larger return indicates favorable financial management. From an investor's perspective, Nike takes the win by a pretty significant margin in this measurement.
Hi everyone, my name is Dan. And when comparing the two companies together, out of the 6 ratios we compared between Nike and Skechers, Skechers only holds 2 over Nike, which are the current ratio and the debt-to-asset ratio. And that just basically means Skechers can pay off their obligations and liabilities faster than Nike does, although respectively Nike is a far bigger company. They have a lot more obligations and liabilities to worry about and pay off, and they still do them relatively fast. As you can see, their ratio is still healthy. And then in terms of investing, Nike is the way to go. And when you think of a company of who you want to invest in, you have to consider is who is their competitor, what is their purpose, and who is their market. While Nike is a global company that most everyone knows about, almost everyone has at least one Nike product or has seen a Nike ad in their life. The famous Nike swoosh, for example, is their biggest trademark, and anytime someone sees that, they know exactly who that belongs to and what that represents. Nike has one of the biggest markets there is for an apparel company, because not only do they have every type of sportswear, they also have leisure wear, swimwear, and business apparel. And Nike is a top competitor in all of those aspects in today's market. And based on their financial accomplishments, I do not see them going out of business anytime soon. And then as far as profit goes for investors, the return on stockholders' equity alone is tripled compared to Skechers. And compared to Skechers' earnings per share, Nike's is also greater. So why not invest in more shares of Nike, even if they are more costly? But overall, those two companies are very healthy, but Nike is far better in my opinion to invest in.